Hello everyone and welcome to the new edition of In Chat with Daman Asset Management team. We saw a strong performance in both equities and fixed income during the month of August. The MSCI All Country World Index was up 2.4% and the Bloomberg Barclays Emerging Market Index returned 0.97%. Although we are still maintaining our overweight in equities versus fixed income, however, in the equity space, we are becoming more selective by having a more diversified approach between defensive, cyclical, and value sectors. On the fixed income side, we downgrade investment grade to neutral and continue to have a neutral approach on the high yield.
The big event in August was Chairman Powell's speech, which was sufficiently dovish to interpret QE tapering later in the year, probably in November, with a gradual reduction in asset purchase given the economy evolves broadly normal, which is in fact widely anticipated. He reiterated that this decision depends on the state of economy, the labor market, and of course actually the gradual pace of tapering. Additionally, Powell stressed that the decision and eventual rate hikes are mutually exclusive events. Still in August, the Delta wave has been more modest globally, but global risk to EM from COVID-19 remains and have weighted on EM activity and sentiment. COVID-related risk to the outlook will continue to occupy the public debate and hit EM disproportionately harder, partly due to the weaker efficiency of vaccines in some EM countries that biased governments toward further rounds of mobility restrictions. Most of the recent economic activity data and surveys reveal a clear softening in growth momentum. The latest manufacturing PMI suggests the loss of momentum in the gradual goods producing sector at mid-year intensified in August. This data also suggests that supply bottleneck issues are far from over as delivery time and price components continue to deteriorate. Consequently, we are worried on EM inflation and see it as a higher mark as price pressure are broadening amid renewed pickup in food inflation. The acceleration of global core inflation has taken the center stage this year, but the latest data shows that food prices are now also accelerating. EM inflation forecasts continue to be revised higher, but the outlook is still for moderation in 2022. Finally, just one word on EM policy normalization, which has broadened since the start of the year, but overall magnitude of tightening outside the first mover group is fairly modest and largely gradual. The main risk for EM high yielders group is that raising inflation and tightening both monetary and fiscal policy result in a period of stagflation. A dynamic, in fact, which is present and evident in Brazil and more globally in Latin America, where we have continued to revise inflation higher and grow slower.
As we mentioned earlier, we still do see some room for upside in the high yield credit. And this was specifically supported by the IMF Board of Governors' approval of the SDR allocation on the 2nd of August, equivalent to close to $650 billion, of which close to $275 billion was allocated to the emerging markets and $33 billion was allocated to the African countries. Now, when we look continent by continent in Southeast Asia, our positive pivot since the last quarter towards Sri Lanka and Pakistan has continued to see merit. Both countries received a much needed capital injection via the SDR allocation, Pakistan receiving close to $2.77 billion and Sri Lanka receiving $800 million. Additionally, Sri Lankan reserves were strengthened further by $150 million from a swap arrangement that they entered into with the Bangladesh Central Bank, and further $300 million from the Chinese Development Bank, which is part of the allocation that they received of close to $1.5 billion. Now, given this continued support that we see for Sri Lanka from China, we see upside in this credit. Now, when we move over to East Europe, we like Ukraine, as we saw a ratings upgrade this month, as its public debt to GDP ratio is expected to decline further in 2021, driven primarily by budget outperformance, a recovering GDP, and this is definitely supported by a credible macroeconomic policy framework and a record of multilateral support from agencies, including IMF, but just not limited to it. Now, closer to home, when we look at the Middle East, we continue to favor Bahrain, Egypt, and Jordan. Bahrain is cheap, according to us, on a technical basis across the belly of the curve and offers a very good relative value play, in our opinion. Additionally, Bahrain received an SDR allocation of $540 million, and this should support it further, and definitely its external borrowing requirements are met with this. We prefer the belly of the curve again for Jordan, and we have been positioned very early on in this, and we have seen merit. We remain overweight in Egypt given the likely continued improvement in its fiscal metrics. We think it definitely offers a strong carry, though spread tightening may be limited by the continued heavy supply that we're seeing amid large external financing needs that it has. However, a positive that has come recently is the anticipated Sukuk issuance, which we feel might be interesting given the passage of the new Sukuk law. Finally, when we move towards Africa, our pivot to Angola has paid off as it has outperformed the entire SSA credit this year, given catalysts from the recovery in the oil prices, China debt reprofiling, positive IMF fifth review, and the DSSI extension. When we look on the technical side, Ghana is relatively attractive, and we have favored Gabon for the past 2 months and the short end, especially the short end of the curve. And Fitch recently upgraded Gabon from a CCC rating to B-. Specifically, again, there was a key trigger point where the sovereign entered an IMF program, and higher oil prices definitely helped the liquidity pressures. Additionally, it's also planning to reprofile its external debt, making liability management for the 24 and potentially 2025 bonds likely. Ivory Coast has also outperformed recently, mostly in the dollar bond space versus the euro bonds, as it became a fully BB credit, with Fitch upgrading it to BB, and S&P recently assigning a debut BB rating. Potential discussions additionally with the IMF funded program in 2022 also support this credit. To wrap it up, Rwanda completed its second ever Eurobond issuance of $620 million. This was via 10-year paper offering 5.55%. And the main purpose was specifically, again, to restructure the maturity profile, and we favor it given the macroeconomic approach that it's taken, which has been very sound in terms of managing debt levels, inflation, and currency depreciation.
Despite the spread of Delta variant, concerns around inflation, recent deacceleration in PMIs, especially in US and China, global equities have witnessed a strong rally year to date, with MSCI All-Country World Index rising about 15%. Strong earnings growth momentum, policy support, and global liquidity have underpinned the markets. However, underneath the benchmark, we have seen a constant rotation between growth and value. And over the last 3 months, value has underperformed growth on Delta variant and global growth concerns. On the Delta variant front, we have started to see the peak in infection rates and hospitalization in US. China has been able to bring the recent spike under control, and cases have come down in pandemic hubs such as Mexico and South Africa. Hospitalizations in Europe have remained low despite increased infection rates. Therefore, we expect the global economic recovery and earnings growth to continue, albeit with growth slowing down versus 2Q levels. Also, this time around, taper has been well communicated, and as pointed out by my colleague Thomas, the Fed Chairman Powell has clearly segregated taper from rate hikes, and tapering announcement is expected to be delayed towards end of the year. However, we continue to see a further upside in global equities and advocate a barbell approach. Valuations are not stretched as MSCI All-Country World Index 1-year forward PE multiple has come down to 19x from a peak of 24x at the end of 2020 on a continued upgrade by the street, and 10-year treasury yields remaining much below its long-term average. We are neutral on US and keep our overweight on Europe given its valuation discount versus US, and vaccination rate expected to reach 70% of the population by September 2021. We maintain our neutral stance on EMs, however tactically upgrade EMX China to overweight given our expectation of delay in tapering. In EM Asia, we like an exposure to South Korea, Taiwan and India. In EM MENA, we favor Saudi, UAE and Qatar, and Mexico and Brazil in LATAM. Year to date, MENA has been the best performing region in the EM, with S&P Pan Arab Composite Index up 27% due to a sharp rally in oil price, higher vaccination rates, lower cases per capita, and supportive policy backdrop when compared with other EMs. Also, there has been a strong push by the major economies to enhance the contribution of manufacturing, technology, F&B, trade, logistics, and tourism to the GDP and improve FDI. Under the projects of the 50 initiative, the UAE has announced visa reforms and aims to attract $150 billion in FDI to be amongst 10 biggest global investment destinations by 2030 and double its GDP. As a result, along with our preference for the value and cyclical stocks in banks, construction materials and industrials, we also prefer bottom-up plays in sectors such as retail, food and beverage, and information technology. We have also witnessed a further relaxation in travel restrictions in the region, especially with the UAE allowing vaccinated tourists. Hence, we have increased our exposure to the reopening plays. We continue to avoid Turkey due to the path of monetary policy remaining uncertain and have kept a limited exposure to Egypt. We have initiated a position in Middle East Paper Company, which is a leading manufacturer of container board in the region, on our expectation of a continued upcycle in demand and Saudi authorities banning raw material export.
Thank you for taking the time and watching another edition of A Chat with Daman Asset Management Team. You can always contact us on our website and social media platforms. Till the next edition.